We are witnessing the greatest bubble in history, one of extreme magnitude. What is truly different this time is that we have never seen investors rely so heavily on a central bank before. Previously, it would have been the consumer. Today, it is understood that the consumer can only push it so far. We must now rely on an ever-increasing supply of funny money to satisfy the thirst for more and more gains, more chaos. Are you ready for a wild ride? You came here for the truth, so let me unveil that for you. I've got a lot of truth to get into today. We are going to look at what Jerome Powell and Janet Yellen have to say as it relates to what's happening right now. I think it's important to watch these two, obviously being in their positions, but of course their history, and that has led up to this point. It is so integral to what's happening right now. I've got some charts to show you, and at the end, I probably won't have enough time, but if I do, we're going to talk about Ray Dalio's latest post. So let's get into it right away. This is what I wanted to start off with today because it's going to set the tone for the rest of this video. Wall Street is inflation-proofing its debt market portfolios. Some of the world's top money managers dial back duration. Leverage loans, you've seen me get into that before. CLOs, oh my goodness. Floating rate notes see a surge in demand. The rise in inflation set to accompany an economic boom is threatening to reverse the 4-decade decline in US interest rates, sparking a rush to protect the value of trillions of dollars of debt market investments. This, of course, would be a huge reversal in trend. I mean, we have seen since 1980 interest rates declining further and further and further and further, and now they are at the ground floor. When they tried to bring them up, as you know, they couldn't even hit 2.5% before they had to bring them back down. So clearly we are at the bottom. However, if inflation in fact does pick up, as many have started to predict, this is something that they just can't flip a switch and turn it around very fast. This is something that needs to be some extreme action, and that is coming from the central bank. The central bank, the Federal Reserve in this case, needs to implement what they did back in the late 70s into 1980, and that is increasing interest rates. And that would, of course, put an extreme damper on the whole economy. I mean, everything, top to bottom. So you know that this is an issue that they are all watching. The belief is that they can keep this tamed down, but we know that everything that they have supposedly tried to do has never worked in that way. And the bond market, it seems, is never really fooled. If you watch the stock market, things move up and down so rapidly, but the bond market tells a very different story. Diverging Fates Leveraged Loan, Junk Bond Returns, Trounce High-Grade Debt to start 2021. It's still early in the year, of course, so we'll see what happens, but this is what you have when there is that seeking for yield. When you look around and you're thinking, well, I can get that negative yielding debt, or I can go into the junk and leverage loans and get some return. You've seen what the risk taking brings in, and that is never a good thing. Oh, don't worry, it's not a problem like we had with the subprime crisis and so on. But I don't believe what they say. We only find out afterwards. The point here is that things are in fact changing. Wealthy investors still love stocks, but real estate is on fire. Tiger 21 members think retail stores are doomed, but industrial and workforce housing is hot. For all the talk about how stocks may be overvalued, almost 2/3 of the members of an elite multimillionaires club expect the stock market to end 2021 even higher. And they're just talking about the way that they are putting their portfolios right here. I know the font is quite small, but essentially what we're looking at is a breakdown: 27% real estate, 26% private equity, public equity 22%, and it goes on. This just gives you some insight as to what the big boys are doing. And then you look at what JP Morgan and Morgan Stanley and Bank of America and all of them are looking at. Essentially, The belief here at this point is that the Federal Reserve has boosted up asset prices. Inflation is potentially on target to go well above where we have seen it before. And this, of course, impacts everything in the financial system. This has to be mitigated if it gets too far. And what is the only way to do so? Increasing interest rates. Nobody is prepared for that. And listen, we don't have to see 20% interest rates for there to be a problem. At 2.5%, they were a problem just a few years ago. 2.5%. So if you really want to stamp out inflation, how in the world are you going to do that if you can't even get interest rates to 2.5% without crashing the economy? That's the question I pose. There are so many areas right now that are booming as it relates to real estate, but not because of something going on in the area, not because they found gold and the gold rush is on or some sort of new development in these places. In fact, it's simply areas that are, let's say, away from it all. This happens to be Joshua Tree, which is an area in California. You know, you look at the images and it's basically deserts and rocks, and you see that there are so many. And this one that they're showing right here is a $5,000 a night, something like that, $5,000 a night to stay in this place here in the middle of the desert. Now, it's obviously a nice looking place, but it's just showing you where, you know, there's been this huge ups and downs. You got millions of people who aren't even counted on the unemployment statistics, never mind those on unemployment. But you have others who are able to stay in a place that's $5,000 a night. It just shows you this grand disparity in between the two. And real estate right now is obviously way out of whack because the city centers, which are usually really hot, which are usually much more stable, have really been turned upside down because the suburbs have grown in popularity and demand, and the city centers have been sort of, you know, a lot higher vacancies and so on. So things are definitely sort of up in the air. Surging U.S. yields loom over emerging markets beholden to the Fed. Implied volatility posted its biggest weekly gain this year. Inflation data in Brazil and Mexico to offer clues on policy path. Rising U.S. Treasury yields are starting to concentrate minds in the world of emerging markets. Developing nation local currency bonds had their worst week since September in the 5 days through Friday, while dollar debt slipped by the most since January as surging inflation expectations fueled a rout in treasuries. They just go on, okay? But the point here is, I'm seeing this all over the place now. There's this expectation, and that's part of what happens. It's the expectation, not necessarily that it's going to take place. You know, when you see the Federal Reserve is going to implement quantitative easing, we expect that to happen at the next meeting. Okay, the market starts pricing that in. It's as if it doesn't really matter if they ever do it or not, as long as they say they're going to do it. Forward guidance, as they like to call it, that is already priced in. It's amazing to see the way that they react and actually overreact to information that hasn't even happened yet. It's crazy. But one of those that I've been seeing everywhere, just, you know, 2021 essentially, but in the last few weeks for sure, that is the picking up of inflation to a level that may become uncontrollable. Two charts from the Fund Manager Survey in Bank of America. The Fund Manager Survey investors continue to think emerging markets will outperform. The question being, what asset class do you think will outperform in 2021? Emerging markets was on the top of the list. Oil beneath that, and the S&P 500 below that. Private clients love emerging markets. You could see the emerging markets flows and just showing you compared to the developed market flows, giving you an idea of how this has all been. And it is very clear right now at this point that emerging markets are seeing some definite love, a lot of money flooding in to emerging markets right now. I want to talk about what Yellen and Powell had to say, show you a little bit of information, and mostly Yellen, of course. But what we're looking at here is part of one of those articles, but I wanted to lead with it. Easy come, easy go. Financial conditions loosen as markets boom. Of course, you could see this, and I've shown you this chart many times before as time has gone on. We're looking at a case in which the market continuously is dealing with lower interest rates, more expectations from the central bank and the stimulus packages of the government to be there to support the markets, boost them up, give them some fire in their behind. And it is just dropping like you wouldn't believe. I mean, just take a look at that on the right-hand side. You could see for yourself. This really tells the investor, in a sense, not directly, of course, they may not see this chart, but that things are getting easier, the money's flowing out there, the Federal Reserve is going to be there, so now is the time to take risk. But this cannot go on forever, and the more risk-taking you get, eventually that blows up. That's the problem. You have to, the point I try to make when I say something like this is that you have to hedge your bets. You have to be aware of what's going on. You have to be always diversifying what you've got going on, or else at some point, whether that's 2 years or 5 years or 10 years, you end up taking big losses if there is no diversification. Janet Yellen and Jerome Powell appear wary of signs of froth in the financial markets, even as they press ahead with economic stimulus measures that are elevating the euphoria. I'm glad Bloomberg was at least able to publish that. There may be sectors where we should be very careful, Yellen said. And that was when she was asked about the possible speculative sizzle. Of course, they're saying, oh, it's just GME and, GameStop and AMC and those stocks, right? Right? No, it's a lot more than that. The remarks came a day after publication of minutes of the Fed's January policy meeting, at which staff characterized the risks to financial stability as notable. Wow, we got that far with the Federal Reserve. One word, not bad. An assessment that Powell shares according to a central bank official familiar with the matter. So not much there, of course, but what we can see is that they're at least aware of what's going on and acknowledging it, but what they're going to do about it, nothing at all. Yellen favors higher company tax, signals capital gains worth a look. They want to bring this wealth tax. They want to increase the corporate tax to 28%. We'll see what they actually do. None of their policies ever actually help anything. They never fix anything. They are always making it worse. And we will have companies that continue to move overseas as a result of all of this. Or you could see internal moves that take place. You have people and businesses that go from California to Texas to Arizona, wherever it might be, Nevada, or they might go to places like Florida and other places. Okay, you've seen all these videos I've done, and I know you've seen the information before. Why? Because they'll do anything to reduce their tax burden, whether it's a company, whether it's a person, anything they could do to save money. That's what's happening. It has always been this way, and it's accelerating today. A little bit of humor here. Yellen signals interest in backing digital dollar research. Okay, it makes sense for central banks to look at issuing sovereign digital currencies, Janet Yellen said. I mean, this is what at one point she's saying, okay, we should do a digital dollar and so on. All the central banks right now are talking about it or implementing it as we speak. But it's pretty funny because the dollars, it's already digital. I mean, they just print it into a machine and that's it. You can have an infinite amount of cash available to you. We already have that. So the fact that they have to create a digital dollar, to me, it smells fishy because there's going to be something else in there that it's something different. It's not just the fact that it's gone digital. There's something else hiding behind the scenes. There's no doubt about it. Yellen also had this to say about Bitcoin. I don't think that Bitcoin is widely used as a transaction mechanism. To the extent it is used, I fear it's often for illicit finance. Okay, right there, gotta stop. I had shown you, if I'm not mistaken, I know I talked about this before, that the conditions right now where you have these illicit financing, as she calls it, are taking place are done with cash. They're done with cash, okay? They're done with cash. They're not done with any digital currencies. That would be ridiculous. It was as if you go to make a deal. Okay, you're going to pay me $1 million for that stuff. Okay, sounds good. You go home and now you have $800,000. That's how rapid the changes can happen. Does that sound like something you would do business with, moving money around, especially when all of the transactions are public on the blockchain? Doesn't make any sense. It's so strange. Even the World Bank, if I'm not mistaken, had done a report about it and actually documented the fact that almost all of the transactions for illicit finance are done with cash. There are facts to back that information up. But I think it's funny because their digital dollar, oh, that's okay. But this other currency that's trying to come up, oh no, that one, it's bad. Look, it's all, sort of up to the user, to the actual consumer to decide what to use. And I think that that's the important point. They don't want competition. And I think they're making that very clear. As I expected, didn't have a chance to get into this article, but you want to check it out. There's so much information. In fact, I might do an entire video about it. There's so many charts, a lot of stuff. Ray Dalio put this out. And what I like about Ray Dalio's reports is because I call them reports because it's not just an article. He really gives depth, gives you a lot of information to check out. And the title, of course, Are We in a Stock Market Bubble? So if you want to check that out, it will be in the description as always. Quick point before we finish off the video. This is a Wall Street Journal article, and it was talking about the breakdown of the new stimulus package. And there's a lot in here that you should be looking at. But one of the points that I wanted to make clear, because the pension issue is something that I have covered for years, since the beginning. And of course, we know that this is destined to fail, and a lot of people will be left with nothing. But anyway, the bill includes $86 billion to rescue 185 or so multi-employer pension plans insured by the Pension Benefit Guarantee Corp, managed jointly by employer sponsors and unions. These plans are chronically underfunded due to lax federal standards and accounting rules, yet the bailout comes with no real reform. That's right. Here you go. Here's some money. Keep burning it. They are supposedly guaranteeing 7% returns or what have you, and there's no possible way they can ever do that. They're taking more risk. They never actually resolved the problems they had back from 2008 and so on. Those really have been suffering ever since. And of course, just another day. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting this channel by clicking a button on your screen. You help me out. Thank you very much. If you want to learn about e-commerce, you can do so for about $1,000 or $2,000. They have some great courses out there, really help you out. But if you just want to learn for free, you can do that at the AmazonGPS.com. If you want to know the financial system from top to bottom, you want to get all the details you need to know, explained extremely easily, these two books will do just that. Check it out at the link in the description. And if you haven't seen this video already, definitely check it out. Okay, I'm talking about Michael Burry and his talk about Weimar Germany. So you got to click on it. I'll see you there.